In this video, I want to continue talking about adjusting entries, and this time I want to focus on deferred revenue. This is when a customer pays cash in advance of the business actually earning that revenue. In other words, it's before the company has provided the service or delivered the product to the customer. And this is going to create a liability because the business owes the product or the service to the customer. And a lot of times you'll see it called unearned revenue. And even though it has the word revenue in it, keep in mind that this is not a revenue account, it's a liability on the balance sheet. So you'll need to be aware of that so you don't put it in the wrong place. So what I'm going to do is just walk through an example to show you how this would look. So let's use the example of a client hiring the business and paying $1,200 cash upfront for a service. If the company hasn't actually performed any of the work, provided the service yet, this is going to create an unearned revenue. So you would make an entry. Let's say this happened on December 5th, and you would debit cash because you're adding to cash with a debit for $1,200, and you would credit unearned service revenue. And I'm going to go ahead and make the T account so we can look at this with the T accounts also. So since unearned revenue is a liability account, we're adding on the credit side, subtracting on the debit side. Okay, and then what would happen at year end, the company would probably do some adjusting entries. And part of that process would be looking at this account, and they would want to figure out if they've earned any of the revenue by that point. So let's say at December 31st, they're looking at this account and they realize that they've performed 2/3 of the services for that client. So if you take $1,200 times 2/3, that gives you $800 that they've earned. Well, it doesn't make sense to leave it in this unearned account if they've earned it. So you would want to move the $800, and you would want to move it to the regular service revenue account. So to do that, you would do another entry. And I want to point out that I'm using December 31st as a year end for all of these examples just because it's easier, and that's usually the common year end. But some companies do have a different year end than December 31st. So I just wanted to point that out. So to move the $800, we want to subtract it from unearned revenue. So we would do that with a debit. And then we would want to place it in the regular service revenue account with a credit. So for revenue accounts, we add to those with credits, subtract from those with debits, so they have the same rule as the liability account. Okay, so I'm going to go ahead and put this in the T accounts. $800 went on the debit side of unearned revenue, which that brings the balance down to $400. And this represents what they still have not earned, the other 1/3 that they're going to earn in the next year. And then in service revenue, you have an $800 credit, which represents what they've earned in the current year. The unearned account would be on the balance sheet, and their service revenue account would be on their income statement. Now, if you're in a class, you may just be asked for the adjusting entry itself, the second entry that I did, but I feel like it's important to know what already happened before that adjusting entry took place, which is why I also explained the first entry. And that's all I wanted to cover in this video. If you have any questions, feel free to comment below, and thank you for watching.